Is weak jobs still good for markets? The latest jobs report has investors asking if we're heading for rate cuts or a recession. The S&P touched a new high and slightly up for the week, but ended on a sour note. Let's quickly recap. Short week with Tuesday opening lower as investors await new jobs data. Wednesday saw July job openings slip to just 7.2 million, below expectations. Most sectors were underwater, but a big tech court win lifted markets. Then Thursday, weekly jobless claims ticked higher, and ADP private jobs added only 54,000, about half what we saw in July. That softer data had investors cheering for a Goldilocks scenario for rate cuts. The S&P even climbed nearly 1% heading into Friday's big report. But Friday flipped the script. Unemployment ticked up to 4.3% for a second straight monthly increase. Meanwhile, non-farm payrolls came in at just 22,000 for August, way below expectations for 75. Meanwhile, revisions struck again. While July was revised up a bit, June went negative, turning into 13,000 job losses. Overall, another 21,000 jobs off the books. Investors were hoping for a weak report, but this one just felt a little bit too weak. The S&P slipped Friday, but losses were mitigated as optimistic investors rallied at the end in Power Hour. But clearly the tone has clearly shifted. Is this slowdown healthy to get rate cuts or flashing recession warning signs? So what's next? Well, we'll have to wait another month for more jobs data, but focus will now turn to inflation. We'll get both the CPI and PPI next week, the final puzzle pieces before the Fed's meeting and rate cut decision the following week. So again, what do you think? Will jobs bounce back off these levels? Or are we looking at the start of more pain? Let us know.